let's start now by talking about the first key function that we serve for our clients, which is portfolio management. I'm going to turn it over to my colleague, Peter Sengelmann, who is our Chief International Investment Officer, and he is going to be walking through with you our approaches to building effective investment portfolio strategies for our international clients. Peter?
Absolutely. Thank you, David. Thanks, everybody, for being here today. Very excited to present this to you. And what I'm going to go through for you is our approach to investing. And I think you can use this approach on your own. And what I hope to get across to you is a very successful approach that has worked through various market environments. We'll even talk a little bit about today's market environment and what to do at this time. So our approach is really built on 4 pillars. You see the 4 pillars laid out here, the first being diversification. Then we focus on strategic rebalancing. 3rd pillar is low expenses. And 4th pillar is tax optimization. And what's the common thread amongst all 4 of these is that these are things that we can control. So I want to walk you through in more detail through each of the pillars, but I did say I was going to talk to you a little bit about the current environment. So markets are quite volatile these days, right? There's a lot of geopolitical concerns and worries about inflation and so on and so forth. And so what I find as an investor is it's helpful to take a historical perspective, right? To think about, has the market here, the equity market, and in this case, we're showing you a long-term price chart of the world equity market. This is the MSCI World Index going back to 1970. So we have 51 years of data here. And we're looking at the amalgamation of the performance of 3,000 companies around the world and how they've weathered the various storms that have occurred over the last 50 years. I mean, look at some of these events, right? We have super high inflationary periods, we have subprime mortgage crisis, we have COVID-19 pandemic, et cetera, et cetera. And through it all, had you been invested and remained invested, you would have come out with a very attractive rate of return in the end. Now, markets have fallen substantially in 2022, as many of you, I'm sure, are aware. And so how should we be approaching that? How should we be thinking about that? Well, again, looking at history as a reference point, we see that on a historical basis, after periods of decline, the first 3 set of bars talk about a 10% decline in stocks, the next 3 set of bars, a 20% decline, and then the last 3 set of bars are a 30% decline in the subsequent returns over a 1-year, 3-year, and 5-year period. And you can see those returns after the market decline are quite robust. And this even argues for maybe now is a potentially attractive entry point if you're thinking about it. So rather than we playing defense, maybe now is the moment to be thinking about playing a little bit of offense and taking advantage of the downfall in stock prices. Now, over a long period of time, what we find is that stocks, on average, here we're looking at all the way back to 1926, annual data of the US stock market and the rate of return for each. So each box represents a different year. And if the box is red, the rate of return was negative in that calendar year. And if the box was blue, it was positive. The closer it is to the middle, the smaller the deviation from zero. And as you get out to the outer bounds, the red to the far left is a larger loss and the blue to the far right is a larger gain. But you can see that the blue outnumber the red by a factor of about 3 to 1. So odds are, if you're investing in stocks, your chances of having a positive rate of return in any given calendar year are about 3 to 1 relative to a negative rate of return. So that should give you hopefully some sense of comfort that stay disciplined, stick it out, and look to the future. Now, that doesn't tell the whole story, of course. We are investing a lot into the stock market. There's a lot of volatility that comes with that. And so this chart, again, shows you that year in and year out, on a calendar year basis, we see that stocks generally are producing positive returns as depicted by the solid blue bars or columns. And so more often than not, those bars are positive. They're pointing up. This is the Russell 3000 index. So now 3,000 companies in the United States stock market. The little skinny lines, whether they're the blue ones going up or the red ones going down, are showing you that during that same calendar year, however, there might have been a lot of variability in the prices of stocks. So stick to it, because while there's a lot of variability along the way, while the ride can get somewhat bumpy, as we've seen in those historical charts, things come out pretty favorably if you're willing to stick through it. So now what we have is a demonstration of various asset classes, right? So our first pillar of investing is to be diversified. So I was talking a lot about stocks. I talked about global stocks and US stocks, and now let's look at various asset classes. So this chart is incredibly hard to read. I don't expect you to look at the data and try to parse it. So I'll briefly explain it to you, and it's really just for illustrative purposes. So we're looking at a 20-year history of calendar year returns. So on the far left, you have 2002, and all the way to the far right, just shy of the far right column, is the 2022 year-to-date returns for various asset classes. And each asset class is depicted by one of the boxes. The colors stay the same throughout. So if we look at the far left, 2002, the top left corner box were bonds. Those were the best performing asset class in 2002. If we look at the bottom left, we have US large cap stock. Then what we've done is we've highlighted in red, we're following the journey of US large cap stocks from 2002 all the way up until 2022. And then on the very far right column, we see the resulting average rate of return, and US large cap stocks come out sort of closer to or below the middle, right? So what we want to think about here is, why should we not just have 100% US large cap stocks? Well, because you can see that at various points in time, US large cap stocks are not the best performing asset class. We do not want all of our eggs in one basket, right? So the first tenet of investing to protect your wealth and grow your wealth is to be diversified. So how do we go about doing that? All right, so here's an example of a portfolio, a representative global portfolio. This may or may not be a portfolio that a client owns. All of our clients have customized portfolios, if you can believe it, because we always customize client portfolios based on their own personal preferences, as well as what's appropriate for them. And Dave will go into more details on financial planning that really plays a big factor in how we design portfolios for each client individually. Nonetheless, here's a sample with a 20% bond allocation, 75% stock allocation, and a 5% real estate allocation. So I want to highlight a couple things for you. First is, look at the bonds. We have not only US bonds, but we also have global bonds. Look at the stocks, not only US stocks, but also global stocks, even out to the far-reaching, smaller markets of emerging markets, right? And then lastly, we have US real estate investments, as well as non-US real estate investments. And so the second part that's incredible, I mean, just think about this. The average intrinsic cost of this portfolio, to be invested in this portfolio, is 0.07% per year. I mean, that's incredibly low cost, right? So down at the bottom of the slide where the mouse is circling, you can see that the average cost of these various investment vehicles, because of the proliferation of so many investment vehicles and the competition in financial markets, prices have been driven down, right? We see a lot about inflation in the news. Here we have disinflation. So prices are very, very low. You can get access to global markets. But okay, so what? So we have a diversified global portfolio. So what? Who cares? How is that done? Well, incredibly, looking at this portfolio over a nearly 30-year, 3-decade period, we see that on average per year, the return is almost 9%. Not year in, year out, but on average. So of course, there's going to be times where rates of return are great and times where they're not so great, but you can see over any single 5-year period within that 28-year period, the return has always been positive. But let's pick on the worst 5-year period. The worst 5-year period is highlighted there in the red box. In that period, the second year of that was when stocks fell some 50% in 2008 in the global financial crisis. Even including that time, the 5-year return, had you remained invested in this portfolio, would have been almost 12%. Given that stocks had fallen 50% after 5 years or over that 5-year period, inclusive of the 50% decline, you still had a positive 12% rate of return. It's quite saying something. I'll say it's rather impressive. Now let's go on to the second pillar. Second pillar is strategic rebalancing. So think back to that chart we just looked at, where you had all the asset classes bouncing around, and you had large cap starting in the bottom left corner, and then moving its way to the top, and then back down to the middle, et cetera, and bouncing all around. So as we have a globally diversified portfolio, diversified not only across currencies, diversified across economies, diversified across industries, sectors, and asset classes, and we see that each of these asset classes in different parts of the world are doing different things, we want to stay true to our asset allocation. So therefore we want to be strategic, but we want to take advantage of those movements away from our allocation and rebalance. So this is what we're talking about by strategic rebalancing, is taking profits on those that have done well in a tax efficient manner in view of your unique tax circumstances, and then allocating that money to some of the positions in your portfolio that maybe haven't done so well. Now, is this a time determined process? No. This is not, let's do it quarterly, semi-annually, annually. It's a dynamic process. It's market driven. So we're always, at Creative Planning, we're very fortunate to have a large trading team that's blessed with good trading systems, so they can monitor this on an ongoing basis. Now, the third pillar is low expenses. We saw in the representative portfolio that we had the expenses very, very low. So now I said, that is just a representative portfolio. Our portfolios are bespoke for each of our clients, but I would anticipate that a portfolio of US exchange traded funds should have an average blended intrinsic cost of about 0.1% or below, just because the nature of exchange traded funds in the United States. And then moving to the last pillar, which we call tax optimization, it's really about deferral and minimization, right? So this is something we're doing as part of the portfolio management process all the time. If we're doing rebalancing, what's the most tax efficient way to get there? If you have a cash flow, what's the best way to raise the capital? Should we be selling in this account? Should we be allocating assets to that account? What types of securities should we be using, right? In the UK, that's particularly relevant. So all those things, which we're going to go through in the next section, David's going to talk about financial planning and all those aspects of how we're going to build portfolios in a tax efficient manner, that feeds right into this portfolio management process. But before I go and give it back to David, I want to leave you with one thing. Now, we're subject to cognitive biases, right? Whether it's professional investors or individual investors, markets move, our cognitive biases play tricks on us. And so what our job is to help you stay true and stay disciplined to the process, right? So that's a lot of what we've put together in the portfolio management process. The 4 pillars that I just went through with you is to help you stay disciplined and stay focused so that you don't make the big mental mistakes and shoot yourself in the foot. So thank you very much for your attention. David?
Great, Peter. Thank you very much. And I can't overemphasize the importance of that last point, especially in a year like this, where markets are volatile, portfolios are down generally, and people are inclined to allow panic and fear and concern about where markets are going to move next week to overwhelm them sometimes. And we are talking to our clients every day, especially these days, focusing on the medium and the long term, and not letting them succumb to acting out of the latest headline or the latest move in the market, because that is a sure recipe for not succeeding in investing.